The U.S. Federal Reserve cut the lending rate, a move that was widely anticipated. Let's take a look at how that played out today on the markets with Phil Blancato. He's chief market strategist at Osaic. Thanks for joining us today.
Thank you for having me.
What kind of reaction did you note today?
You know, what was fascinating to me was we finally saw interest rate sensitive securities begin to have, or really continue to have, their moment. Think about the rally in small caps, the positioning in value stocks. You're seeing this opportunity for other areas of the marketplace really grow. And that's one of our themes for 2026, that the broadening out of the market, you're seeing concerns around AI spending, AI revenue, AI application. So other areas are going to have that opportunity. It's interesting for not only for the bond market, specifically for the bond market, but also other areas of the marketplace, and small caps is a great example of where the market's going.
Okay, the Fed indicating the bar is going to be higher for any other rate cut in 2026, but there's also a change of guard next year. So what's your expectation in 2026?
The front end of the curve is still a bit too high. If you look at where the real lending rate should be, the natural rate, if you will, it's probably somewhere around 2.75%. With the front end still up there between 3.5 to 3.75%, we need to see another 0.5% come out of the front end of the curve next year. So I think 2 more cuts for next year. I do think there's probably a pause in January, let some capitulation happen. It wouldn't surprise me to see something in that March, April timeframe, and then we'll see where we go from there. But with the new Fed governors, new Fed chair, there's going to be more of an appetite to cut. I think we get 2 more cuts next year. The market's going to anticipate that, and that's why I think you're going to see real success in the bond market, real success in interest rate-bearing stocks, or stocks that care about interest rates.
Okay, but that being said, what kind of data do you think it would take to get there? Clearly, Jerome Powell was concerned about weakness in labor and some softening there. Would it take more layoffs, for example, for that to happen?
You make a great point. This is very critical. There's 2 ways to look at this. If we get softer inflation data and a moderate employment market, then that, to me, is exactly the Goldilocks moment that we want. But to the other side, if we get a weakening labor market and they're having to cut the state of the labor market, very different narrative. Then we're looking at a scenario where we probably see a pretty significant sell-off on the equity market. We see a piling into fixed income, and that would be a concern. That doesn't seem to be the case. I think you get some more deflation from AI. I think you get some more deflation from our demographic makeup in the United States, some deflation from the post-tariff world or less tariff impact. And that scenario, to me, gets PCE down to 2.4, 2.3, and that's the reason to cut. However, if, to your point, if it's because of a weakening labor market, that's a different narrative, and I would have great concerns for the equity market, especially at these valuations.
All right, let's get to a couple of your stock picks. You like Morgan Stanley. What makes it stand out over other financials?
There's a few things they're doing well. When you think about the diversified revenue line they have is exceptional. But when you look at their earnings growth, it's really very impressive. You look at their net interest margins, one of the best in the industry. And you look at a company that not only has made recent acquisitions that really bolster its bottom line, I think you have a not exceptional earnings growth profile. Now, I know the stock's done well, but in a time when banks are going to really benefit from deregulation, I think this is a name that you could hold for a long time. Not only their organic growth, the acquisition, but certainly from the diversified revenue stream is a reason why you want to own this stock.
All right, let's get to another pick of yours, which is FedEx. But trade has thrown off package delivery, right, across North America and really you could say around the world. Why do you like FedEx? And is it using AI in any way to drive efficiencies?
You're making this easy on me. There are 3 reasons why I really like this company. 1, they took $1 billion in debt out. 2, they pay a wonderful dividend, 5% dividend. You know, folks, when we've forgotten how valuable it can be to be paid to wait around. Start the year with a 5% dividend. That's very impressive. And the third one, you hit on it. I think AI really bolsters their opportunity to increase their profit margins. We're wondering when AI will add to the bottom line of companies. This is a great example of using AI to better meet their supply chain issues, better meet their delivery issues, to control their staffing. So I think the AI application here makes a profound impact on their revenue. And for those 3 reasons, you want to own the stock.
Your last pick is Southern Copper. They participate, I guess, in all stages of the process. Where do they operate?
They're mostly in South America. There's a number of countries in South America where they operate. And why I like them, we don't make copper in the United States. And at a time we're going to do a gigantic rebuild of power grid in the United States, whether it's data centers to electrical lines and everything in between, you need a lot of copper, not to mention electric vehicles. So I think at a time when demand for copper is going to significantly accelerate, targeting a company that, one, has done a very good job of managing their debt. You look what they've taken debt out. They're Mexico, Peru, Ecuador, Central, South American focus. They've lowered their debt. You look at their price to book. Very inexpensive company, and a company that can meet that supply or partially meet that supply chain demand for copper. I think it's a bit of a speculative play, don't get me wrong, but then you can own and really benefit as this data center demand only accelerates in the years to come. You mentioned some of the data center numbers coming out of just Oracle alone and how much power is going to be needed, as well as data centers in general.
And let me ask you about where they are operating. We saw Peru, we saw Ecuador, we saw Mexico. Any challenges in those markets? We know that some of the miners are having challenges when they operate in certain other countries.
That's the speculation that you do have. Would you run into a tariff issue, and would you run into a simple challenges around the country that they're based in, political headwinds, and then more importantly, can you get an agreement with not only the local population to be able to continue the mining, but with the United States? I think you got to take some risk in your portfolio. That's why I put this out as a riskier name. But it's something we have to have, not want to have, something we have to meet this AI demand that's happening. So that's really my driving force here. And in a world where you're going to need this copper supply desperately, you're going to have to get it from somewhere, and I think they can be a player in that space.
Phil Blancato, appreciate your time, sir. Thanks for joining us today.
Thank you.